Welcome to the Dividend Talk podcast, episode 166. Navigating the current market and our current Q3 portfolio performance. Whether you're a seasoned pro or just getting started, Dividend Talk is the place to be for insights, analysis, and unsalted advice on how to make the most of your money through dividends with our own unique European flavour. Oh, and don't forget to subscribe to our podcast and join our community on Facebook at Dividend Talk. See you on the inside. We're back, European DJ. We had a week off, but we are now back.
A week off. You just took a week off. Come on, what was happening there over on the island there?
Yeah, we know I was meant to record. Well, we were meant to record early, and on the Wednesday night we had some storm, it was more like a little mini hurricane here, and all the power in my whole area went, so we couldn't record. The next morning I was gone on a plane to sunny Spain, so it took away our chance to record. But hey, at least I was in the sunshine. That's all I can say. I missed a ton of bad weather over here. It was horrendous by all accounts.
Well, you brought quite some storms back into the stock market as well on your returns. So it's will be a really nice topic for today, I would say.
Yeah. The market seems to be taking a little bit of a turn. But hey, look, let's maybe talk about some of the news of the week, because we got a lot of questions, particularly last week when we announced that we were doing this podcast early. NN Group had just released some news. It had hit their stock price pretty bad, and we've got maybe 7 questions from 7 different people about them. Being someone from the native Netherlands, tell us what happened with the NN Group.
Yeah, so this goes back all the way to the early 2000s. Yeah, that's important to know. So I believe in 2006 or 2008, ING, as an example, a company that NN Group was part of. They got effectively into trouble for, selling, I think the English word is usury, unit-linked policies, and specifically around life insurance or something like that. So what effectively happened, and this was, I think, going on from 1995 or 6 all the way till, I don't know, 2003 or 2006, so a decade long. What they effectively were doing is they were just putting so much costs on the customer. So let's assume you took a mortgage on your house, right? In the Netherlands, when I had such a mortgage, you wouldn't pay off your mortgage. You wouldn't have any monthly payments. What you would do, you would put the money that you're paying monthly in an investment account, let's say from NN Group, and then NN Group will invest it in you in some mutual funds. And then the idea is that if your mortgage term is 30 years, that after 30 years you can pay off with those investments the money that you owe to the bank. Yeah, so you're building up capital effectively in an investment fund. Why they are doing that? Really simple. At least at that time, I don't know if it still applies. You could deduct the market rate from your tax. Yeah, so it's good to keep a lot of mortgage, let's say, in on your balance sheet, let's say, as a person, because you had a lot to deduct then, and that's why you could live relatively cheap. And I think this is also why so many Dutch people have so much debt in the housing market. And if foreigners look at it, they think like this whole country is literally underwater. Yeah, so. But what NN Group and such companies were doing, for instance, your first year contribution of money, let's say you invested 10,000 euro the first, so you contribute, let's say, 1,000 euro each month, so 12,000 the first year. approximately probably 3,000 euro was just going into startup costs. So there was only 9,000 euro working for you. After 1 year from all the money you put in. But that was like that. Then there were continuous maintenance costs that were sometimes far above 3.5% here, while your return was maybe 7 or 8%. So you were already losing almost half of your return as well on this. Now, I'm giving here example of a mortgage-backed, investment policy, but you had it with life insurance mainly here, and this was a big scandal that I think, that hit the media around the great financial crisis, if I remember correctly. And then there was there was a group of let's say considerate victims or people that wanted to claim. They went to court saying we want that money back. Now there was already some compensation, I think half a decade ago, 5-6 years ago. I mean, it's been running now for almost 20 years, right? So I don't know exactly anymore the timing, but I signed up for that petition. And I remember getting some money back. And I think I got money back on the transaction costs that they charged me too much on that account. I remember something like that. So this is effectively what this is all about. It went to the Supreme Court not too long ago. So, and then the Supreme Court effectively, or the outcome of that was effectively that NN Group shouldn't pay. But now it went back, and even I think went to the Court of Justice of Europe. But now it went back to the Dutch court, and they looked at the interpretation and the information and say like, well, no, on many of the claims, NN Group is liable and they should pay something. Now, NN Group is going to appeal. They go to the Supreme Court with this. They say that the judge hasn't made the right conclusions based on how the Supreme Court gave it back, because how the system works in the court system is like, the lower court, they can ask the Supreme Court for for kind of an opinion or something like that on okay, how should we make this interpretation of this law in this case, and then they do these statements and you go back and you move on as a judge. So that's the case here, and of course it spooked everyone, because people are then afraid like, wait a second, they have so many customers, if they all need to pay this might lead to, I don't know, bankruptcy or something like that. I don't think that will happen. I think the dividend is probably safe enough here with the knowledge that I have today and the calculations I made. Maybe as a sneak heads up, let's say sneak preview heads up. It's the main topic of the article of our newsletter this Sunday. So NN Group has a 40-page article, and I've gone into the court ruling. I read the entire verdict. I analyzed everything, took some assumptions based on past of such cases, and I entirely did the analysis of what the impact of this court ruling is and what dividend growth investors should consider here. But I'm not afraid. There is of course a risk. The risk was much higher than before this verdict, but personally I'm not afraid.
And what about companies like ASR? Are they embroiled in anything like this?
So what happens with such a court case is sets a precedence. So ASR is also therefore subject to this based on the court ruling. So ASR has also potential impact. I didn't really go deep into ASR compared to NN Group. But we have a saying in the Netherlands, and it's something like, you don't eat the soup as hot as it's being served. And that's kind of how I think about this situation here. I do expect that the companies, depending on the timing of fines or a potential settlement, might need to stop the buyback program. I honestly think and predict that it will end up in a settlement for the simple reason NN Group can delay so much here by another few years of procedures in the courts. that I think these lawyers that are already 10 or 20 years on this case, they probably want to do something else with their life as well.
Yeah.
So I believe they will probably go for some big money, cash in, and then so I think there's a high potential here for settlement.
Yeah. Time will tell. It certainly shook the market. Well, the two companies, ASR and particularly NN, last week. I'm not sure if they've bounced back since. It seemed like a huge reaction.
They found the floor. They have
Yeah.
found the floor.
Yeah.
Yeah.
So let's see. I have to say I've read your article. It's quite in depth. It covers a lot of these topics as well. So I would recommend reading it. But yeah, it's interesting, isn't it, to see where this goes. And like you, I think NN Group can drag this out if they want. It's probably in all their favor now just to settle it up, get rid of it, and move on at this stage. But
Yeah.
let's see. Hey, you're playing both sides of the coin, so you can't.
Yeah. So I might actually get some money from this. So yeah, maybe it's even more than my position in NN Group. Who knows?
You can reinvest it in NN Group then.
Yeah, but I had a small mortgage at that time. So, but still.
Cool. Let's move on to Walmart. They've had another dip in the market, and it's all around weight loss drugs. And we spoke about this before with Novo Nordisk, and
yeah, we were joking about it.
Yeah, how these weight loss drugs are going to affect everything, and consumers are not going to buy much. And guess what? it's exactly what's happening. There's fears that these weight loss drugs are causing people not to buy as much, and of course this is seen as a red flag for Walmart, and their share price has dropped.
Yeah, not only that, it was PepsiCo, it was Coca-Cola, I believe even Clorox, because the whole consumer staples sector went down. What people need to know is like nobody, I believe, is drinking Clorox products, right? But I would also advise not to do that. But what people need to know is in such situations, many investors own such positions also via ETFs. So what also happens here is often index selling. So that's why you see also often other consumer staples being dragged down in these regards. But yeah, for me, this is so funny. But for me, this is also a typical example of an overreaction. Do you really think that people will not drink Coca-Cola anymore because of weight loss drugs? I mean, you can drink Coca-Cola Zero.
Yeah. Well, do you think they're going to stop eating food? I mean, how much?
Well,
food,
if you look at the share price, you will believe that. Yeah,
Yeah.
there's a total Armageddon coming up.
Yeah, it's crazy. Yeah, but the whole market has been pretty red this week, and it's been good. It's all part of our story navigating this market, and it's be interesting. We'll talk about that a little bit later on as well.
Yeah, definitely. But for me, I mean, Novo Nordisk, the most valuable company in Europe, because of a drug that allows people to reduce their lose their fat effectively. I mean, it's the irony of our times, right? That the most valuable company is the one that lets people lose millions of kilos. And let's say the most valuable company before was probably the one that created the most kilos, like Nestle or something like that in Europe.
Yeah. Yeah, hey, swings and roundabouts, isn't it? We go one way or the other. Yeah, let's move on. We have Philips. There's a news item here, and I must admit, I cannot read it because it's in Dutch. So
No, that's okay. So, I owned some Philips for some time. I sold it already quite quickly. I learned that I bought a cat in the bag because Philips just continues to struggle with these respiratory devices. And in this case, the FDA is not satisfied enough with what they have done so far. And they believe that Philips will need to test much more and analyze much more to properly assess the risks regarding the recall of their devices before they can totally agree on Philips' stance here. So it's again a setback. Again, cost will be involved. Price dropped again. I mean, management, please, why can't they just make a clean ship at once, straight away, be the best boy in class there? I mean, the FDA is not a party to fool around with. Yeah, and you're already a European company. You're already zero, as I said, 2-0 behind. Yeah, if this would be an American company, I'm sure it would have been a little bit easier. Yeah. But here, they don't have any association with Philips. They don't need Philips.
No, no, not at all. Yeah, look, it's one of those ones that you flagged really early. It looked cheap, but it's probably one of those ones that was a falling knife, wasn't it? It was too cheap. They were just embroiled in a lot of litigation. Didn't look like they knew how to handle that litigation, and
Yeah,
it still seems like they're a little bit clueless, to be honest. So
exactly. Exactly.
stay away from them. And then the last bit of news of the week is Exxon Mobil are talking about buying shale drilling company Pioneer for about $60 billion. What do you make of that?
Yeah. Well, ExxonMobil is still a big position in my portfolio, somewhere in the top 10, and I like it. I mean, Exxon has a really good balance sheet. I was considering selling in the past, ExxonMobil, because I didn't see them growing anything. I didn't see them responding to market dynamics. I didn't see them trying, how is it, clean energy or something like that. But I mean, if you think about, they're just buying cash flow here. They're buying a few really high cash flow, cash flowing assets here. I mean, the deal's not done yet, right? These are, I guess, still rumors to some extent. But not knowing them too well, Pioneer Natural Resources, but management has a good track record when it comes to acquisitions, and 60 billion is not pocket change. That's a significant amount, but they can relatively easy carry it with their balance sheet. So
Yeah, it's an interesting one. It gives them more access to that Permian Basin as well, which is I believe is a premium in that world. So it
and more important, some dividend growth again.
Yeah, of course. And I was going to touch on it, but you did before me. It was maybe this time last year you were thinking of selling them, and something held you back, and it turned out to be a good move at the time.
Yeah, I like I don't. So I love management that they are so strict on their balance sheet and are protecting the dividend. That's what I really like about ExxonMobil. What I don't like is that they are not moving at all with how the world is. They're just, I don't know, they're just not acting on everything that's happening. And that's why I like the European oil majors a little bit more, but also Chevron. Chevron has been heavily investing over the last years. And yeah, it's been just dead quiet with Exxon.
Quiet is not always bad. It's not always
No,
bad.
no, maybe it's a lesson for me that's actually something I should appreciate more.
Yeah, yeah. Okay, then moving on from that, then it's probably a good time to talk about what is actually happening in this current market. I think all week we've seen on Twitter, I think Dividend Wave is posting every week. There's a different sector that's completely red on FinViz. And lots of people don't know what to do. It's kind of panicky. What's your take? What's going on in the market?
I don't know, of course, entirely what's going on, but my sense of this is that it all started a little bit when the Fed said like higher interests for longer, higher interest rates for longer. And when I hear this, I think like, am I surrounded here with a bunch of idiots in the stock market? I mean, it was already lower interest for longer. Then it was transitory. Was transitory inflation,
Yep.
and they got caught by surprise that it's there to stay. Remember, it was also there to stay. Then the interest rates, they go quick up, but they might fall down quickly as well. Yeah, and now it's higher for long, but that this is not like a shark teeth inflation situation that we're in. So I don't understand why people build all their models like the Wall Street analyst on that this was just short term. I think it was a desire for it to be short term, I think, but I that's not how quick governmental and central bank policies work. Yeah, if now shit hits the fan, they can put the how you said the interest rate on zero in no time, but that's not happening. The underlying economy is doing relatively so, I would say, but there's not a shock in the market at the moment.
Yeah, I think it's waiting for that big shock. But what I got from this week is, yes, they're talking about the treasury rates, the 10-year treasury rates at at an all-time high. I think they're higher than they were in 2007 before that financial crash. They're talking about high oil prices, the strong dollar. The dollar just seems to be getting stronger and stronger. So the consensus is that this soft landing that we've been hearing about is no longer a high probability. It's probably going to be a full-blown recession. There's probably going to be blood on the streets, and people are going to lose a lot of money. So there's a lot of panic around that. I'm like you. I'm flabbergasted why people are surprised at this. I mean, let's be honest. The US, they don't really have a good track record of being open and honest and telling you, okay, this is what's going to happen over the next 5 or 6
Yeah.
years. They pretend to be surprised every time this kind of event happens, but
I sometimes wonder if they use that to let the smart money go short first.
yes,
Yeah, to enrich themselves and then start changing the message.
yeah. I mean, we talked about that on the show. There was it Michael Burberry? Is it? I can't
Yeah.
remember the guy, and he was at 1.6 billion short on the market. I mean, these guys don't put that type of money in
Yeah.
without a reason.
Yeah, but he predicted 15 of the last 2 recessions. Yeah, Michael Burry.
He does, but he has a lot of money to predict them as well. So it's for me, it's a strange one, and why people are shocked. But look, when we have this scenario, it creates obviously panic in the market. There's lots of red, and people say buy the dip. But how do you navigate this? What are your thoughts? Are you
Well,
shifting?
before we go there, there's still like a parallel that I want to share.
Go for
I
it.
still vividly remember 2007 and 2008, and I remember that in that time before the summer, I think that there was some trouble. But then the market went a little bit sideways, and then it started to, like, also in the fall, started to do a bit more difficult. And I believe that was in the fall of 2008. And then suddenly one of the big banks, was it Bernsteins or something like that, fell down. And that's when, after that, really, I think the first bank was still okay, but then the second bank maybe was where it came. But it all started in the fall. And I'm not saying that there's now such a big company there to collapse and that we do the same, happen the same, but it kind of, so far as how the year evolved, it feels a lot the same. Yeah. And we do know that there are a lot of zombie companies. Yeah. So there needs to be just one big company that has been cooking the books or something like that, which was already high in debt, that can create an issue to the market. But I don't see any system risks. For instance, with the banks, it was really they had inflated everything with these market-backed securities. It was just not worth anything, and it was really systematic risk. If I read everything what's being said about the bank, they should be so much more capitalized. And I know this from insurance companies and looking at the solvency ratios, they can really absorb a shock, right? So I don't see that now, but the question is, like, if something really happens, where's the blast zone? So in 2008, it was the banks. In 2020, it was anything that required foot traffic. Yeah, and you don't want to be in the blast zone. So if something happens, my advice is really stay away from the blast zone. That's my rule. So I was not buying anything that requires foot traffic or in-person business model during COVID. Yeah.
Yeah, yeah. It's look. It's hard to know what the blast zone will be at this moment. If you were to guess, where would you say?
I really, really don't know. I mean, I do think there's a lot of bad debt in general. If many companies that have been doing massively buybacks. The real estate investment trust sector has a lot of debt as well. Might struggle with refinancing there, but I think they have been punished already more than enough for that with the current downturn that we have seen in that sector. Other than that, I can't predict it. It's if something happens, it will be like Nassim Taleb always says, a black swan.
Yeah.
You will say afterwards, yeah, we could have all seen it, but up front, it's really, really hard to say. And like I always say, I can't time the markets. I know a thing or two of economy and how you said macro, but I also know that it doesn't really matter. It matters maybe to the stock market, but I always believe it's a market of stocks.
Yeah.
So from that point of view, and we had a whole show about that not too long ago, that I don't really look too much at it. And I actually just enjoy what we're having now.
Yeah, I mean, I honestly don't look at my portfolio. I think we have a question later on about starting investing and always in the red, and what do you do? But honestly, I don't look at it. I can see the stock market is down, so I presume my portfolio is going to be down at that point. But also that gives me opportunities, if I have the cash, to buy some companies that I'm maybe holding off on. Maybe like your Texas Instruments are in that group, your Hershey's, and stuff like that. So yeah, I try not pay too much attention to the broader market. I am expecting some sort of big bang, like you said. There will be a trigger. I don't know what the trigger will be. We had banks collapsing at the start of the year. We had lots of stuff happen this year, but we're still waiting for that black swan event that would
Yeah.
really send everyone over. Because I think we mentioned at the start of the year, yes, there was a bit of noise, but I still haven't seen that real panic in the market yet.
No. And maybe to put things in perspective, the S&P 500 year to date is up by 13%.
Yeah, so
Yeah, and if we go to a year, it's up by 18%. And last December was not a nice time for tech stocks. Remember, December, tech stocks slaughtered. Then it went to a high in early February, and then in March we were experiencing also something like this. What was then the issue? Financial stocks got slaughtered because of
yes.
this Silicon Valley bank that collapsed. Then the only way was up since then, and now we have been, since let's say the start of September, going down almost in a straight line. But if you think about that, we're talking about 5% down or something like that. But over the last 6 months, we're even still 5% up. So, it looks so bad everywhere. But the stock market year to date is just making like a double-digit growth.
Yeah, it's as you said, it's up year over year. It's up year to date. It's up in all ways. But as I said, the panic is just not there yet. And I'm waiting.
Yeah.
I'm actually waiting until I'm starting to read everywhere on Seeking Alpha and everything.
Yeah.
Sell, and then I know we have it.
Yes.
This is where we're at. This is the bottom, and we can start buying the heap loads. But honestly, when you talk about it like that, we're what 5% down. It's just like a normal dip in the market at the moment.
Yes. Or in the stock. We experience this more often in the stock after earnings report or something, right?
Hey, Intel does a customer 10%. So
Exactly. So for me, this is just a golden time, because I do see that dividend stocks have been hit hard. Generally, if you look at our portfolios, they went much more down than the average market. And I think this has to do with a rotation in the stock market, where or out of the stock market potentially, even because many people, and we get this question so often also on the social media, like, if you can get a 4.5% treasury, why would you take a 4% dividend stock? Yeah, my answer is because the treasury yield doesn't grow. Yeah, once you own it, my dividend stock over the next 30 years does. Yeah, and I don't want to invest in bonds for such reason. I can imagine when you're a bit older that this is a nice time for your mix to have a safety in your portfolio. If you say 70% stocks, 30% bonds, then this is an awesome time probably for that point of view. But for me, no, this is now perfect time to buy those dividend stocks that actually were always a little bit out of reach so far from a yield attractiveness point of view.
Yeah, balance sheets are key. I think balance sheets are key.
Yes, and for that we have done quite some homework over the last 2 years to make sure that we avoid a little bit those shitty companies. But honestly, I mean, I cannot spend more money in general each month than I can save. Yeah, so in that sense, it's just dollar cost averaging for me. I wouldn't know what to do else. How about you?
Yeah, and the same. Just every month, same time every month, that money goes automatically into my broker, and I either if I buy something that week or the next week, but it's there. It's not in my account, and I'm not going to change. And I very rarely, as I said, I very rarely look at the value amount in my portfolio, because it's pointless. it doesn't mean. And if I was to focus on that, I would, you start to panic. Oh, I'm
Yeah.
down 10 grand, I'm down 20 grand. It's natural your brain starts to think that. So when I log in, it's actually hidden. I don't even look at it. It's irrelevant.
Yeah, no, that's not relevant. So what I am doing now is taking this opportunity, specifically in October, because September I wasn't really focused on it yet, but to look at higher quality stocks. Yeah, to really beef up a little bit those positions that I have in my tier 1 or tier 2. And that might also be meaning entering a new position or something like that. There are stocks. Even I was looking at Coca-Cola this week. Now it trades around $52, $53, 3.5% dividend yield. I believe we will do a stock card for that in the upcoming newsletter, right?
Yeah.
So I'm really interested what comes out of it from a dividend safety point of view and such, because maybe Coca-Cola might be for once something to start, flirting with a bit, let's say.
Well, I think that's actually a good time to move into our portfolio review, because one of the companies that I bought this week was Coca-Cola. I bought not another. I sold them a long time ago, if you remember. I felt like there'd be no growth and waiting to see them turn around, but I think they came out of that, and it was unfortunate they hit COVID at the time, and they've hit a bad run, but I think they're performing pretty well. So I bought another starter position in them. I think 20 or 30 shares in the company this week, because I felt like I was buying a lot of high yield companies. I was buying Vici, I was buying NN Group, and I want to start balancing up, particularly as you said, in this kind of market where things are starting to go down. Yields start to become more attractive. I think Coca-Cola is 3.5% or something like that. So it's a decent time, I think, to start a position or increase your position in them. I know Pepsi as well is getting quite similar, but the only thing about Pepsi is their cash flow, the last time I looked, was very worrying. So I prefer Coca-Cola in this instance.
Well, Coca-Cola is generally just a higher margin business from that point of view. If you compare the two, that's always really interesting. Yeah, so I get that, and Pepsi indeed still needs to come a bit more down for me to be attractive as well. Yeah.
So I'll just talk a little bit about my portfolio over the last 3 months. Dividends this quarter, my average has been €206 per month, with my highest month being July at €412.
Wow.
That's actually 63% higher than this time last year, which is actually quite something. My projected annual dividend income is now sitting at close to 15% of my overall goal.
Wow.
So it's getting there. Seeing that tick up, it felt like it took ages to get to 10%, and now once it get past 10, it seems to creep up that little bit higher. But obviously, I've been buying a lot more higher yield. I spoke about that. I've been buying NN Group. I've been buying British American Tobacco. What else have I been buying? Vici is quite high as well. So that's obviously driving my paddy up quite high. Financials is my biggest sector at the moment, because I hold NN Group, I hold Legal and General, and they are two companies that are in my top 8. Shell is still my number one. It's still my number one portfolio.
It's hard to get rid of them, right? And the number one.
I mean, I haven't added any money to them. It's just all appreciation, capital appreciation, but they sit at number 1. Unilever sit at number 2, and T. Rowe Price sit at number 3 for me. But yeah, Shell and Unilever just keep staying there, which is quite something, considering I haven't bought them, haven't looked at them in about 18 months. They just seem to keep going. I do reinvest the dividends when they come, obviously, but they are the king of my portfolio.
Nice. And any learnings from this quarter?
I mean, this quarter has been just kind of ticking over. As I said, I've been buying some high yield stuff, and I was looking back on that at the end. I bought Enegas, I think, as well. And looking back, and I remember at the start of the year, the goal was to buy quality, and I'm looking, maybe I'm chasing yield. So when I saw the stock market actually drop, I had sold actually WP Carey after the dividend cut, and I reinvested that money into Coca-Cola. So I took it out of WP Carey. I felt like with management, honestly, I didn't feel like they needed to cut the dividend. I know that they're spinning off all their offices, but actually they were selling them off as it was. I think they
Yeah.
sold 35%. They could have continued to do that and kept the dividend, but I think the spin-off was just an expensive way for them to cut the dividend because it's been so slow growth. So they want to reset that back and
Yeah.
maybe they'll start growing again. But look, once you stop trusting management and their decisions, it's time to get out. So I exited that and said, Coca-Cola, steady dividend grower, solid company. I stuck my cash
Yeah.
into that instead.
Yeah. Makes sense. Makes sense. Well, but it's really inspiring to see your growth, because I remember the first time we started the podcast, it was like a few pennies, right? And now
Yeah.
it's some really serious money what you're getting there.
Yeah, it's interesting actually. August, I don't know if I've miscalculated something, but August is only €65. I'm
Yeah.
pretty sure that should be a little bit higher than that, so I'll have to double check. But even so, 200 euro on average per month. As I said,
Nice.
I remember last year I was trying to get to 100, and it seems like
Yeah.
it's just doubled quite quickly.
Nice. Nice. Well, I honestly had a pretty good quarter. Invested actually a lot of money again. If I see these values, then it's almost unbelievable. But I've been on a buying spree. I bought some more legal and general, high yield, Enegas, high yield. I entered the position in Agree Realty. I bought quite some realty income, not from a yield point of view, but highest quality real estate investment trust, A-rated balance sheet, for instance, for realty income.
Yeah.
And I see Agree Realty as the younger brother. And you know what it usually is with the younger brothers, right? They learn much more quicker from the older brothers. So that's how I look a little bit at Agree Realty. I bought some Texas Instruments. That's for me high quality when I think about them. I bought some Defama. It's a German real estate company, and we had Matthias Schrader one time here as a CEO on the podcast. Also high quality for me. I bought a share in L'Oreal after I wrote the first newsletter as a token of appreciation. Also high quality. And I bought some NN Group and ASR in the last quarter. So all in all, I'm very happy with these additions. Yes, I used the opportunity a little bit for some higher yield in the insurance sector still, but other than that, some really names that I really want to have in my portfolio. And like we just discussed, in the upcoming quarter, I will hopefully, if the market stays like this, even add more high quality there. I also sold some shares. I sold my position in Kimberly Clark. I had it already for 2-3 years. That money, I don't see it growing at all there. I don't have any faith in the business in the sense of that it's going to give me a decent return. So I felt like it's not even giving me so much yield. There are better opportunities here. So I used it, for instance, to buy some realty income and Agree Realty. And the same with 3M. I sold now in total 60-70% of my position over the last few months. So I still have a little bit left. But I used 3M. I used 3M in that sense to buy a little bit of NN and ASR after their crash. I didn't do my full analysis yet at the time, but I felt like, so it was a bit risky probably to do that. But I felt like, okay, which litigation do I want more? One that is related to health, and there's and in America, so there's effectively an unlimited upside, or something more financial. And I felt like, well, if I have to choose about litigation, I'll rather take a financial impact, because I've got 3M then, right, with the earplugs and the PFAS. Now the PFAS, I think this is the yeah. I still have Bayer with Monsanto in my
Yeah.
portfolio, so I'm looking now also of disposing Bayer probably maybe in the last quarter, because it's also been that money. I'm all the time thinking like, when will the company settle? But there's just nothing happening. I believe there should be again a ruling. Was it 2024?
Yeah.
New CEO might also be interesting, so I'm not sure yet. But Bayer as well. Johnson in the portfolio with the talc powder as well. So generally, I don't like those liabilities a lot that are related to consumer health, because those have really unlimited potential around the globe. And this with ASR and then is a little bit, encapsulated in the Dutch financial market. So that's the reason why I felt like, okay, if I need to have fines, then rather get them from NN Group than from 3M. But all in all, my dividend income was doing pretty well. So on average, it grew about 16% compared to last year. July was year over year 51% more, August 60% more, and September 7% less. Last year in September, I believe I got, we got those special dividends from Rio Tinto and BHP Billiton, if I remember correctly, and they fell away. So that impacted here, and also weaker dollar. Although without the dollar, it would have been probably similar year over year. So my portfolio yield went up from 3.8% to 4.1%. It's a bit on the high end from where I ideally see it here, because I'm aiming for a healthy combination of dividend growth and dividend yield. And my portfolio grew quarter over quarter about 3.3%. Technology sector, information technology stays the largest with almost 21%. And also Royal Dutch Shell stays the biggest position for me, both from a portfolio value point of view and a dividend income point of view. Last but not least, you can see it on my screen, the portfolio goal progress. I'm now probably around 56-57% of expense coverage. So
yeah, that's pretty
really
awesome.
happy with that.
I was looking at that chart when you posted it. It's incredible. It's actually like just to see that and where I am on it is I'm actually kind of tracking that quite similar to where you are. So looking at it in 5 or 6 years, knowing I'd be at 50 or 60% is actually quite inspiring. But I was looking, what caught my eye was that dividend yield. I did want to ask you about that because 4%, but 4.1% is extremely high for you. Is that something you're consciously going to look at next quarter, or are you just going to just?
Well, I think it's a so one reason is me buying those insurance stocks so much this year, with 5+% yields at the time of buying, plus portfolio depreciation in the last quarter. Well, actually, not a quarter. It went actually a bit up. So no, okay. But generally speaking, it is all about how much strength of dividend growth is behind it. And in the Dutch insurance companies, I could still, if the settlement or if the fines are not too high, I could still see them continue hiking in the high single digits. Yeah, it's just a really nice opportunity from that point of view. But usually, I would say my ideal portfolio yield has always been around 3.5%, and then 6-7% dividend growth behind it. Yeah,
Nice one.
so more quality. So I want more high quality. So if I look at Coca-Cola, I would go for 3.5%. Let's say it means that my yield will go lower. Although one buy in a month will not bring my yield significantly lower. It's a drop on a hot plate at the size of the portfolio now.
Yeah, it's quite an interesting year. And as we spoke earlier, if there is this big bang, if there is this crash, we're going to see some of these quality companies. Might start to see Nike, we might start to see Hershey's.
Oh,
even the ones that have dropped already, like Target and Walmart, they'll drop even more. So
yeah, that would be so nice.
It'll be good. Okay, time for some questions. I think we have a good few questions, to be fair. So we could be a while to get through these, but let's start with our friend Alan. He's asked us, if you are forced to buy one and sell one from each other's portfolio, which one and why?
Oh, from your portfolio, tell me, your top 10, right? Let me look at that. At the top 10, I would. Sorry.
Yeah, I have it there. You can see my top 8.
Okay, so let's say from your top 8, if I had to sell anything, I would definitely sell Altria.
Yeah, that's the obvious one, I would say. And if you were to buy one, you probably have all of those.
Yeah, but at the current price, I would buy T. Rowe Price.
Yeah. So from your portfolio, I would definitely. At current prices are prices you bought them at. If it was prices you bought them at, it's simple. It's probably Apple or Microsoft way back. And then selling one, I don't know. I would have said 3M, but you still have 3M, yes?
Yeah, a little bit.
Yeah, so that would be the one I would sell.
Yeah.
Matt Barker has asked us, how do you prioritize what you buy each month in the current candy store?
Oh, yeah, that's the hardest question. That's the hardest question. I've done my homework, and we were talking a bit about this also on the Facebook group. So if people want to join, facebookgroup.com/dividend talk. Then someone mentioned like again about the tier one and the foundational stocks. So it was really a good reminder to myself because I've got it all prepared. I've got my tier 1, 2, 3, 4 stocks, and I'm really going to focus on my tier one. And based on that, look at one of those, because if it's really now a candy store, I want the sweetest candy in there that I usually even find hard to buy.
Yeah, it's so hard, isn't it? Because you make lists and lists, but it probably depends on the day and how you're actually how you're actually feeling and what's going on in
Yeah,
the market. Like I wasn't expecting to actually go out and buy Coca-Cola, for example, and I don't know, it just felt right at the time. But I do have a list. I try and stick to dividend safety score. As we said, we've come to balance sheets. We know they're really important. We created our own database now that we track all these, and I think it's quite important that we stick to that. If I learned anything, I've learned that when I went for ones that are junk or close to
yeah,
junk, like WPC was one, for example, they always end up either cutting it or doing something, so something always
yeah,
happens. So sticking to quality. I'd really like to be buying the likes of L'Oreal's in bulk. That's what I would like to be
yeah,
able to buy them at more than just the token share. Do you get me?
yeah,
But yeah, we'll see. Consumer staples. I probably have enough of financials for the moment.
yeah. Me too.
It's because it's quite high in my portfolio. So I want to start going back to a little bit more consumer staples, and maybe a little bit more healthcare as well. That has gone under the radar as well.
I just don't want to buy what I've been buying most of the year this year. I really want to use this opportunity to refresh a little bit with some other stocks that I usually don't look at.
Yeah.
Because the rest of the year, those stocks that we were buying were attractive in a highly valued market, let's say. Yeah, now a lot of dividend stocks came down. So now suddenly those companies that we skipped, and you bring up a good name, Coca-Cola. Coca-Cola wasn't even on the outer circle of our radar. Yeah, but then because of this Novo Nordisk success, suddenly it's in the middle of our radar. Yeah.
Yeah.
And so these are opportunities that I think are most interesting for me now.
Marek has asked us, do you have a checklist before you start a new position?
Well, yeah, it's general those few questions that I ask myself, like, has the company been growing over the last year? Do I think it can continue to grow? And these questions are not easily answered, right? Because it requires really understanding the company, reading an annual report, doing business analysis, listening to an earnings call. So it might sound easy, but that's a checklist. A healthy balance sheet and yeah, dividend commitments. Yeah. So our what is written in dividend policy and in this database that we have been building, I believe we have now 50 European stocks in there or something like that. We checked each and every dividend policy and such, right, to really make sure that we understand what the policy of the company is, and if they are articulating a growing dividend, that gets for me a higher weight than an earnings per share related percentage, right? Because you know that when they have a hiccup, they might kill the dividend or cut the dividend. So those are some of the on the checklist, Marek. Before I start a new position, I just need to understand the company. Otherwise, I don't really want to start a position.
Yeah, just a baseline in the company, and they pass my key metrics. We've talked about. I think we've
Mm.
write about it a bit. We've talked about what we look for in a company. So that's kind of what I look for just before I buy it. It's a simple checklist, and then after that, then it's keeping up to date. It's actually reading a lot more of their annual reports and getting to know the company. Nothing fancy, I would say. MB has asked us when to buy good stocks with higher PE ratios. How much premium should we pay?
So I don't look at the price to earnings as a pure valuation metric from that point of view. But if you want to use the PE, I would look at the PEG ratio, PEG, because it considers growth in there as well based on the analyst estimates. And if you have a pack number between 1 and 2, and you can look for that metric on Morningstar or something like that, you usually know that you have a relatively good value. I believe this metric has been introduced by what's the guy from One Up on Wall Street, the book.
It's gone for me.
Yeah, okay. The author of One Up on Wall Street. Everyone knows the guy with the white hairs. He introduced, I think, this ratio, and it's a good one to look at. But you know, you need to take growth into consideration if you feel like the stock PE is high, and that's why I use also discounted cash flow, because then it can have a higher multiple if at least the growth justifies it.
Nice one. We got asked a question about, do you have a thing regarding investing that is common amongst other investors, but you take no consideration of when investing? For example, I don't care about investor buying or when the stock is low, but I know the average investor often emphasizes this as important.
Well, in insider buying is actually a perfect example, something that I don't look at. I've been fooled by that as well when the CEO of General Electric at the time and their management massively started buying, and then not later there came a dividend cut. Yes, so and then the share price tanked even further in half. So insider buying is a really good one, but also like things like price to book value. I don't look at that. Yeah, there are several of those that I really just ignore, and mostly because they are not interesting for me as a dividend investor.
Yeah, in insider selling is probably another one. When they see people selling a lot of shares, they automatically think it's a time to sell. But
Yeah,
really, sometimes they just need cash, or it's a good time for them
yeah.
to sell out. It's not always a case that the company is dying.
Or is Warren Buffett buying or selling?
Yes,
I
that's
ignore this as well. The other time with HP Inc., people were suddenly buying HP Inc. because Warren Buffett got in the portfolio. Now Warren Buffett has been selling it, and people want to sell it again. I can imagine that you want to track a wealthy investor and such, right? And there's even a proof that even if you track them with a delay, you will still probably outperform the market. So I get that. But I'm a long-term investor. I don't care what Buffett does. I do sometimes use his portfolio as inspiration because I know he buys high quality businesses, and he is definitely a big inspiration to me. But I'm not tracking his moves.
as we often say on this show, you cannot borrow conviction.
Exactly.
So no matter what he does, you won't know if he sells it, you won't know until it's way too late. So that's probably why I don't copy everything he does. JC has asked us, what is your advice to someone who started investing a year ago, in brackets me, but more seriously since June, and sees his portfolio going full red and redder by the day?
Yeah, I can so relate to this. In the beginning, I had as well. It's your hard-earned money. Yeah, imagine that you're investing 200-300 euros a month, not in a savings account, and suddenly you see it became less worth. Yeah, and there goes the bike that you could have bought for it or something like that.
Yeah.
So it's really counterintuitive. But GC, I would just say, like, make red your favorite color. Just make it, because it means you get to buy more of those shares you were convinced about at a higher price. Maybe you get to buy now more of them at for the same amount of money to be invested. So for me, I love red. I'm not concerned because I know that they invest in quality businesses, and if I have 40 or 50 of those stocks, I mean, I can be one time wrong, I can be even 2 times wrong, and my portfolio will overall not really notice it, right? So, yeah, red is a good color.
Yeah, I mentioned this question earlier on, and I knew it was coming, but like I said before, I just don't even look at the value of my portfolio. If you're a long-term investor and what you bought, you trust in it, it doesn't matter if it goes down in the short term. It's more in the long term. I pay more attention to the news, particularly around dividend cuts or litigation and stuff like that. In terms of 3M when I sold them, and also WP Carey, I pay more attention than that than the portfolio value, because let's face it, it could go down, it could go up, but over the long term, if cash flows, if their business is strong, if they have a strong catalyst, their stock price will eventually go up.
Yeah.
We have a question from Dennis, and he's saying this is maybe a bit more country specific, so I assume it's for you. He said in the Netherlands you get taxed for a fictional assumed return of 6.17%. In the last episode, we discussed high yield stocks and indicated that a 6 to 8% for you is no man's land. The question is, knowing you get taxed for this percentage, does it automatically shift your choices towards stocks with higher yield?
No. So I don't get taxed in the Netherlands. Full disclaimer here. But you get taxed. So how it works? They don't tax you, as I understand, on the real return that you had, but on a fictional return of 6%. And I don't know, maybe they get, what is it, 30% taxed on it or something like that. But no, because I assume that there is also capital return involved here, not just dividends. So I think, but I think the other Dutch person should answer this, because they made changes to the law there, to the tax policy, and I don't fully understand them. But in the past, it was a fictional return on your wealth that you had. Yeah, and that's what you pay tax on, and I assume it's still on wealth and such. And in that case, it doesn't really matter, I think. Yeah, I don't know.
Oh, I hate these fictional taxes. We have it in Ireland on the ETFs. It's nonsense. It's absolute
Well,
nonsense.
it's good if you can get a higher return on average. Yeah, it's nicer for the rich people.
Yeah. Finez Land has asked us about Japan. They are offering some great value with stellar balance sheets with many decent dividend increases. What is your take on Japanese stocks?
Nothing, just too far to the east. I'm oriented to Europe and America, and that's already enough for me to follow the news and everything. And I'm not familiar with Japanese culture. I don't read anything about Japan, so I would find it hard to understand the potential of a company. As an example, I've been a few times in America, so I understand a little bit how it looks like there, so I can envision better what the impact of a Walmart is. But I would have no clue what the buying behavior in Japan is, other than that they eat a lot of sushi and love karaoke.
Yeah, they
Yeah,
have some really good companies though, to be fair. Like Nintendo, for example, is one you could probably grasp.
yeah, but it's a
Um,
dividend growth stock.
I believe so.
Okay.
Yes, is another one, a dividend growth stock. There would be a couple out there that would be classed as dividend growth stocks, but like you, it's too far to the east with me. I have enough exposure to the US dollar, Great British Pound, and the euro, and add another currency to my portfolio. I'm not really keen. It'll
Yeah.
probably break my tracker as well, to be fair.
Well, I say never no, right, to an opportunity, but it must be something that's so obvious to me. Yeah, and I've not seen that.
Okay. Everyday normal investor has asked us about our thoughts on companies with heavy exposure to China, all the China-related problems in the market, regarding like a market collapse. So, for example, Texas Instruments has huge exposure to China. What are your thoughts?
Yeah, this is geopolitics, which is impacting, let's say, some companies, and I don't know. Starbucks I have in my portfolio, really depending on growth in China. Um, I don't know. I think most companies have indirectly also exposure to China. We've seen it with the whole supply chain that got disrupted during COVID. So I think the United States and Europe are just married to China, whether they like it or not. Geopolitics will make it a bit, I said, harder, and maybe some more volatility for us. Specifically, if they would like put some export controls on it. We haven't seen it with ASML. But generally speaking, it's impossible, I think, for the Western world to, I said, untangle the relationship with China in even in a single decade. So whether they like it or not, they're married to each other and they need to move forward.
Exactly. And look, there's plenty of potential there. They've got a lot of people living over there
Yeah,
that like all the fancy brands we have over here in US and
yeah,
Europe. So it's only natural they want that over there too. So there is potential for that. Same with India. Huge populations. So
yeah.
you can see why companies target those areas. There's lots of growth potential, but as you said, you don't know you don't know how their government will react or what they can take away or what they can do. Which, but uh,
There's just a lot of populism at the moment,
yeah,
and that's what we hear. Easy talking. Yeah, we're going to, I don't know, let China pay for it or something like that. But China needs to do one thing, and the whole global supply chain is disrupted. I think longer term, like we got a question the other day about the BRIC countries creating their own currency and such. I could imagine that we see over the next 10, 20 years just a general shift in geopolitics, but that's really not my circle of competence. And I will need to see what it does to the stock market. I'm just not good at that stuff.
time will tell.
Yes.
Dividend Yogi has asked us about McDonald's. It's on his watch list. What's your take of McDonald's in the long run?
I think it will do really well in the long run. I still regret that I once sold it because I thought it was overvalued. That was still my days when I was naive in 2016 or something like that. And I heavily regret it. I think that McDonald's is just, I mean, if you drive here in Poland, my kids, when they see the arc, the golden arc already, they start asking for McDonald's food. And you know what? They are fully aware that it's not healthy. Yeah, but McDonald's has so many healthy options nowadays with carrots that they can eat or something like that instead of fries.
Yeah,
So I think also for parents, they give enough healthy option to still make you go there if
yeah,
you want to do your kids also well. And let's face it, kids love it. They love to play there in the playground. It's not too expensive. It's quite affordable. So this business is not going anywhere. And then we haven't even spoken about the real estate part of their company and the
yeah.
unlocked value there.
Yeah, I was going to say it's probably one of those companies it's hard to grasp because you analyze them like consumer staples,
Yeah,
but but they're nearly more like a real estate investment trust. But they've got a, as you said, look, they've got a fantastic business model. They know what they're doing. They're absolutely everywhere in the world. No matter where you go,
yeah.
there's a McDonald's. And if you're stuck for something to eat and you're in a foreign country and you don't know anything else,
You go to McDonald's.
you go to McDonald's because you know what you're going to get. So, I think in the long run, it's a solid choice and look, good dividend payer as well. So I wouldn't be selling them if I had
No.
them. This Ambo has asked us our opinion on Diageo and Pernod Ricard. Um, I have a small bit of Pernod Ricard in my portfolio. I think about 5 shares because they sell my favorite whiskey, and that is the literally the only reason I bought them. Right, but the mad thing about it is when I bought them, or since I bought them, they've been the single best performing stock in my portfolio since. It was every time I look at them, it's incredible the growth that they have. And I bought them for no other reason other than I drink the whiskey Jameson's quite a bit. But look, it's a French company. It does seem like a good dividend payer. It does also seem like a solid business. I like their brands. And then obviously Diageo, we spoke about them on the show. We've done an episode on them a few years ago. At the time, they were overvalued. I think in the current market, they could be after dropping a bit and coming into fair value. It's one that I've said I wanted to own and haven't bought them again, but you've just put them back on my radar. So maybe they might be one I buy in the coming weeks. But yeah, look, I think both of them, strong brand power across both of them. I don't think you can go too far wrong.
So now I know again who the author is, Peter Lynch.
Peter Lynch, yes, yes,
Yes,
yes.
and what is he famous for with his book in One Up on Wall Street? Buy the things you use, you see, you understand. At least if those are good, well managed companies. Now You've just given the example of your Peter Lynch investment.
Yeah, Pernod Ricard, and I can tell you in Malaga, I drank a lot of Pernod Ricard over there. So hey, I'm doing my bit for the company. Roman has asked us about realty income. Are they a falling knife? Everybody's panicking about real estate investment trusts.
Well,
What?
they dropped from $65 to $50. That's
Yeah,
quite a fall, I would say, right? So
yeah,
you could argue based on that's a falling knife, but um, the more interesting thing is how do you catch it, and do you need to catch it, right? And what they say, also Peter Lynch has a really nice video about that. Um, that you wait until the knife is, let's say, stuck in the ground, and then it wibbles a little bit, still wobbles a bit, and after that you buy it. So you don't need to be a hero on the way down. You can just wait until you get proof that it kind of found the floor and starts to go back up again. But it comes back to this whole kind of thing again. I have no clue how to time the market. I'm not a technical analyst. I don't know how to analyze price charts, so I can't tell you. I just look at the fair value of the company, and I think like, I can own it at this price, and that's why I buy it, and that's why I buy Realty Income, and I've been buying it also around the $50 level.
yeah. I think Brad put it perfectly when he was on our show. He said, if you label yourself as the monthly dividend payer, how likely is it to cut its dividend?
Yeah, no, yeah, exactly.
They have to be really in trouble to do that. But look, like you said,
But
I
they
think
didn't say the monthly dividend grower.
no. But like they didn't say dividend cut either.
No. True that. True that.
So let's see. Look,
Getting a bit witty here.
I thought WPC was safe as well. I know they are similar. They're triple net lease companies, but I thought they were quite safe, and they weren't. So look, who knows? Who knows? But I
Yeah.
think the balance sheet of Realty Income was probably better than WP Carey. So time will tell. Thomas has asked us about our thoughts on IG Group, ticker symbol IGG in London. I'm aware of this company. I actually didn't think that they were as good a dividend payer as they are. Basically, they are an online trading platform. It's like Interactive Brokers for all the world, but it's a British version of that. And they have quite a history, not always increasing. So I think we had the kind of capitalist on the show talking about irregular dividends, if I remember correctly.
Yeah.
These would probably be classed as one of these. It's not always up in a straight line. There are some choppiness in there, but as a whole, it's increasing its dividend year on year. I can see the data back as far as 2008, but I believe it goes well past that. They technically like to distribute about 50% of its earnings to shareholders, and it has a really good 7.5% dividend yield at the moment. And look, I think it's a safe bet. Any of these brokers like Interactive Brokers, IG, I think they are good companies. They have consistent cash flows, except for if the market was to crash completely and investors were to pull out. And like you said, if there was a global shift that could affect them. But definitely in the short to medium term, these seem like a good company. I haven't run them through my screen. I haven't done anything else other than look at their dividend history, and I know a little bit about what they do. So yeah, it looks like a good one to add to a watch list, I must say.
Nice.
Shendu has asked us about our thoughts on three companies: Amex, American Express, American Tower, and Target.
Yeah, American Express, credit card company, well managed. I think one of those Buffett stocks. It just doesn't resonate with me. I prefer Visa more, as an example, or MasterCard. Probably because we use them in Europe and I'm familiar with them, and American Express not. American Tower, I think, really interesting with the 5G deployment and everything they are doing in America. I could see, for instance, where AT&T is investing in 5G. I don't think they will earn money from it, but I think American Tower, that's rolling out the whole network, will. and also something like Qualcomm that's creating the chips. I would go on that end of the spectrum when you want to invest in 5G. And then American Tower, I think, is a nice play into this. And Target, yeah, I own it, like it. Well, I said the wokeness issue that they have gave, I think, a nice opportunity to buy. And now even around 100, it's really attractive for me. I bought already quite some Target this year, so although it's nice and juicy or attractive to average down, I want to focus a little bit on companies that I didn't buy yet this year, as I mentioned earlier.
Yeah, nice one. Marek has asked us about UPS. They've got a 4.28% yield. Is it an opportunity now or a value trap?
I don't think it's a value trap, but don't expect too much dividend growth. They did a major hike at the time, was a 50% dividend hike last year, the year before. I looked into UPS so often, but I just have an issue all the time with their pension obligation. It takes such a large part of the balance sheet. That's why I've not looked in, not done it further. But I think it's a well-run business. If you compare it with FedEx has hardly any proper cash flow, free cash flow. UPS is superior to that, in my opinion. So I think it's a well-run business. It's not a value trap, in my opinion. It might be cyclical, because of a recession, people ordering less goods and such. So maybe there will be still better opportunities coming if we really would face a consumer recession.
And then finally, we got it's not a question, it's more so about German dividend taxes. And I know you've looked into this before, so maybe you might go through this with us.
Yeah, so we have a long post on Facebook from a year ago where Rafi Raber was explaining that he couldn't get the stock certificates or the dividend certificates from his Finnish banks because they use Citibank as a purchasing house for the shares. Hence, they get all the dividend certificates. They collect the dividends and share them then with his Finnish bank on his rights on those dividends. But to his surprise, the German tax authority actually accepted his dividend reclaim form. So he was really happy with this. He had a bit of a joke that one of his documents showed the wrong address. So they thought that they both owned the stocks and therefore deducted 50% of what he was requesting. So a bit of an irony towards Germany here, of course. But what he's still saying is that we should still try to recoup the dividend withholding tax, even though we might not have the proper paperwork because of this whole thing with not getting dividend, certificates. And mine was, for instance, rejected on this. So maybe I'll try it next year again, and maybe it will work. So there seems to be like sometimes it works, sometimes it doesn't. For our American listeners, welcome to Europe.
Yeah. Do you know what? It probably depends on what day of the week they get your request and who gets your request. So if it's a Monday morning, it's probably nope. And if it's a Friday afternoon, they'll process it through.
Derek, it took him 1.5 years.
It's crazy, isn't it?
1.5 years, It's I mean, even a pigeon brings a letter quicker and can put a stamp on it.
Yeah, I mean, when you have I wouldn't say so little, but when you don't have a huge amount in invested in, say, European companies, it's really not worth the while. Is it 1.5 years to claim
for
a small?
For me, yeah, but for me, it's still worth. I've got enough dividends here. It's worth to get the residence certificate here from the tax office that I paid my taxes and sent half a package of A4 paper, right? That's reality. That's what I've done. But 2027, if they're really able to implement this new policy that the European Commission has on their desk at the moment, then this should be done in a split second. And I think all those people in Germany there that are reviewing this and processing this, they will be out of a job because everything can be done digitally. Then they will be out of a job.
Yeah.
So they should better be sweet to us and just pay us all those dividends back.
Here's hoping. But as you said,
If they would have done that over all those years, made it easy, then there would have been less need for such a policy. Yeah.
yeah, of course. I mean, to be no need for it.
Yeah.
No need for it. Okay, that is the end of the show. Thanks a million for all the questions. Apologies on my behalf that it's been a week late. I will try buy a generator or have some backup option next time the storm decides to take all my power. But no, honestly, apologies for missing that week. It was a good topic. I would have liked to speak about NN Group last week when it was raw and the news was just out. But it was good to get your reflections on that this week, actually.
Awesome. So, guys, looking forward to the next show again, and yeah, maybe some of you as new members to the newsletter that we'll be releasing on Sunday. Have a good weekend.
Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.